How do you navigate uncharted waters when every decision could make or break your future? That's the central question. The Venture Mindset by Alex Dang and Ilya Strebulaev seeks to answer. This book is not just for venture capitalists or founders. It's for anyone who must make decisions in uncertainty, whether you are an innovator, a corporate leader, or tackling a sudden market shift. In a world of disruption and rapid change, traditional playbooks fail. Leaders face uncharted waters where uncertainty is the only constant, and every move feels like a gamble. Whether you are building a startup, driving innovation in a legacy organization, or steering through an unexpected market shift, the stakes couldn't be higher. The wrong decision can mean losing momentum, or worse, irrelevance. Alex Dang and Ilya Strebulaev deliver a roadmap for thriving in uncertainty. Drawing on decades of venture capital insights and success stories, they share how to embrace risk, think strategically, and spot opportunities others miss. This book isn't just about success. It's about surviving and thriving in the most volatile environments. In this episode, we will explore 7 lessons from the venture mindset that will reshape how you approach decision making, from embracing failure to betting on bold ideas. Whether you are leading a startup or an industry giant, these principles will help you thrive in uncharted waters. Let's dive in. What makes Alex Dang and Ilya Strebulaev uniquely qualified to guide you through the principles of the venture mindset? It's their unparalleled combination of practical industry experience and academic expertise, spanning decades of innovation and research. Alex Dang has spent nearly 2 decades at the forefront of technology and innovation. At Amazon and AWS, he spearheaded the design and launch of groundbreaking businesses in e-commerce, supply chain, and artificial intelligence. Later, as a partner at McKinsey & Company in Silicon Valley, he helped global executives build and scale new ventures. His deep understanding of operational execution and strategic leadership makes him a trusted advisor in the world of innovation. Alex holds an MBA from the Stanford Graduate School of Business. Ilya Strebulaev is a renowned academic and the David S. Lobel Professor of Private Equity at Stanford Graduate School of Business. As the founder of the Stanford GSB Venture Capital Initiative, he has spent years researching venture capital, private equity, and corporate finance. Ilya's work is widely published in top academic journals, and his expertise has earned him numerous accolades. With a PhD in finance from London Business School, he bridges rigorous academic insights with real-world applications. Together, Alex and Ilya bring a unique blend of hands-on experience and cutting-edge research. Alex knows how to turn ideas into reality, while Ilya's academic work uncovers the patterns behind successful ventures. This combination ensures that the venture mindset offers not just theories, but actionable strategies tailored for entrepreneurs, investors, and innovators navigating uncertainty. What if success in uncertainty wasn't just about survival, but thriving? That's the core promise of the venture mindset. A toolkit to help innovators, entrepreneurs, and investors make bold, calculated decisions when the stakes are high. The book builds on a compelling idea. The rules of the game change when you step into uncharted waters. Whether it's a deep tech startup pushing the boundaries of science or a legacy corporation adapting to disruptive shifts, the path to success isn't linear, it's chaotic. But chaos is fertile ground for opportunity, and this book helps you see it. With lessons drawn from decades of venture capital experience and success stories like Airbnb, Zoom, and SpaceX, the venture mindset reveals how to embrace uncertainty, take strategic risks, and transform vision into reality. Many decision makers struggle with uncertainty. Traditional methods are designed for predictability, not for the volatile environments of deep tech ventures or sudden market disruptions. This leaves entrepreneurs and leaders hesitant, often clinging to safe bets or outdated strategies, while missing the exponential growth opportunities hidden in the chaos. The venture mindset offers a practical framework grounded in real world examples and academic rigor to help readers navigate the unknown. From building resilience to aligning incentives and evaluating risks, the book equips you to think like the world's most successful innovators. Without these tools, decision makers risk falling behind in fast moving industries, where the gap between winners and losers grows wider every day. Here is what sets this book apart. It's not about playing it safe. It's about learning to see opportunity where others see risk and acting decisively in moments of uncertainty. In this episode, you will hear 7 lessons from the book tailored for deep tech entrepreneurs, venture capitalists, and innovators. But these are just the beginning. The full book offers a treasure trove of actionable insights and strategies to help you become a more confident, forward-thinking leader. Let's dive into the lessons. Here is the first lesson from the book. Home runs matter, strikeouts don't. Picture stepping onto a baseball field, knowing you are likely to miss 9 out of 10 swings. That's the reality of the game. But when that one swing connects, the ball soars over the fence and the crowd erupts. That one home run, it changes everything. In business and investing, the same principle applies. As the venture mindset emphasizes, venture capitalists expect to fail most of the time, but when they win big. Page 5 in the book. For entrepreneurs and venture capitalists, operating in the deep tech space means navigating uncertainty. Every decision is a swing at something new, untested, and risky. And yes, there will be strikeouts. Failure isn't just a possibility, it's a certainty. But here is the key. You don't need every attempt to succeed. You need just a few big wins. Let's take a step back. Out of every 20 startups, only one typically delivers a 100x return. That single win compensates for all the losses. As Bill Gurley wisely said, if you invest in something that doesn't work, you lose one time your money. But if you miss Google, you lose 10,000 times your money. Page 8 in the book. This mindset isn't just about tolerating failure. It's about embracing it as the price of admission to extraordinary success. Many businesses fear failure so deeply that they avoid risk altogether. They chase small wins, prioritize safety, and punish experimentation. But in doing so, they sabotage their chances of achieving transformational success. Consider the Museum of Failure in Brooklyn, a tribute to ideas that didn't pan out. Among the exhibits are Choosero, a $400 chooser that no one needed, and MoviePass, a $9.95 a month subscription that burned through cash faster than anyone could imagine. These failures are glaring reminders of bold bets gone wrong. You find more about it in the book on page 4. Now, Compare this to Zoom's rise. In 2011, Eric Yuan had little more than a vision and a modest team. By 2020, Zoom was a household name, beating giants like Microsoft and Google. Yuan's obsessive focus on customers, paired with investors who believed in his potential, propelled Zoom into the stratosphere. As the venture mindset notes, the Spande decided to invest in Zoom even before seeing the pitch deck. The lesson here is clear. Take bold swings. Create a portfolio of bets, knowing most will fail. When you win, the impact will eclipse every loss. The alternative? Playing it safe. Like so many companies that clung to the familiar while the world changed around them. Think of Kodak. Ignored digital photography. Xerox, for example. They let their revolutionary R&D gather dust. These companies missed their chance to swing big, and the price was irrelevance. Here is the takeaway. Home runs define success, but only if you are willing to risk the strikeouts. In the words of a seasoned venture capitalist, prune your flowers, don't let 1,000 bloom. Success comes from focusing your energy on the bets that matter most. Let's bring this lesson home with 3 questions to reflect on your business and priorities. What bold bets am I currently avoiding because I'm afraid of failure? Reflect on where hesitation is holding you back from pursuing something transformative. Second one, what opportunities in my portfolio have potential to be a home run? Identify ventures or projects worth doubling down on and those worth cutting. And the third one, am I creating a culture that embraces calculated risks? Consider whether your team feels empowered to experiment, fail, and learn. The path to extraordinary success isn't smooth or predictable, but it rewards those who dare to swing. Remember, it's not the strikeouts that define you. It's the home runs. Here is the lesson number 2. Prepare your mind for contrarian thinking. Picture yourself walking into a room full of ideas. Some seem wild, unpolished, even impossible. Others feel familiar, comfortable, and logical. Which ones would you choose? Most people go for the familiar, conventional, safe bet. But in the venture world, safe bets rarely lead to extraordinary outcomes. Success in deep tech often hides in the unexpected. As the venture mindset points out on page 50, many venture capitalists now think every email could lead to the next Google. And some of the most celebrated investments, like Coinbase, began as cold emails, others dismissed as unconventional spam. Here is the challenge. Breakthroughs in deep tech rarely follow a straight line. Progress looks like nothing is happening for years. You're hustling, experimenting, and learning, but there is no visible success. Then suddenly, the pieces start falling into place. And exponential growth takes over. But here is the catch. You can't just skip the first 5 years and start winning in year 5. Those early years of struggle are the foundation for what's to come. They sharpen the team's focus, refine the product, and prepare everyone's minds for what's next. That's why openness to contrarian thinking and preparation are non-negotiable. Let's take a lesson from venture capitalists. They spend years developing a prepared mind, actively seeking ideas others might overlook. Firms like Excel Partners even formalize this approach, constantly thinking about what comes next and searching for companies that fit their thesis. You can read about it on page 85 in the book. Too often, teams fall into a dangerous trap, sticking to familiar patterns. They hire people with similar experiences, pursue projects that feel safe, and avoid taking risks on the unconventional. Over time, their thinking narrows and they miss the outliers that could transform their business. Remember the infamous myth by a venture capitalist who ignored two Stanford students renting a garage? Those two students were Sergey Brin and Larry Page. And the garage was where Google was born. Decades later, that same investor admitted, yes, even venture capitalists miss, and they miss quite often. Page 50 in the book. But the opposite story exists too. Gary Tan responded to a cold email containing just 0.05 Bitcoin, an odd pitch at best back in 2011. He took a chance, investing $300,000 in what became Coinbase. Within a few years, that investment turned into more than $500 million. More of it, page 50 in the book. The lesson here is keep an open mind. Train yourself to spot opportunities others dismiss. Build diverse networks, hire people with different backgrounds, and create a culture that values unconventional ideas. As the venture mindset notes, networking is not just about numbers, it's about quality and diversity. Page 38 in the book. But be careful. Even a prepared mind can fall victim to bias. It's easy to overlook an unusual pitch because it doesn't fit the norm. It's tempting to ignore someone who doesn't match the pattern of success. But biases can spread like viruses, limiting what you see and ultimately costing you opportunities. Here is the takeaway. Openness and preparation are your superpowers in a world of uncertainty. In the words of Thomas Jefferson, the harder I work, the more luck I seem to have. It's also a quote from the book on page 77. Hustling doesn't guarantee success in the venture world, but it prepares you for the moment when magic happens. Let's wrap this lesson up with 3 coaching questions to help you reflect on how you can prepare your mind for contrarian thinking. The first one. Am I surrounding myself with diverse perspectives? Think about your team, your network, and your hiring process. Where can you invite new viewpoints? Second one, what opportunities have I dismissed because they seemed too unconventional? Revisit a pitch or project that didn't fit your expectations. What might you have missed? And the third one, is my culture open to experimentation and learning from failure? Consider whether your team feels empowered to explore, fail, and adapt. Prepared minds find opportunities others overlook. It's not just about thinking differently, it's about acting differently. The question is, what will you do to prepare? And here we are with the third lesson. Bet on the jockey, not just the horse. Imagine placing a bet in a high-stakes race. The focus isn't on the horse, but the jockey, the one with the skill, vision, and ability to adapt. In the world of venture building, this analogy holds true. The best ideas can fail without the right people to bring them to life. As the venture mindset emphasizes, always consider investing in a grade A person with a grade B idea. Never invest in a grade B person with a grade A idea. In the book on page 123. In deep tech, this principle is a cornerstone of success. Founders often work in environments of constant uncertainty. Technologies may require years to refine. Markets might shift unpredictably, and the path forward is rarely clear. In such conditions, execution matters more than initial plans. Only a resilient, adaptable team can transform a bold idea into a thriving enterprise. Consider the story of Slack. The company didn't start as the communication tool we know today. It began as a gaming platform and it failed. Yet Stuart Butterfield and his team refused to quit. They pivoted, building on their existing technology to create one of the most widely adopted workplace tools. Slack's journey underscores a critical truth. The team's resilience often determines the outcome. Page 119 in the Slack was eventually acquired by Salesforce for $27 billion. Success on this scale comes from placing trust in founders with the vision and capability to navigate challenges. Many organizations still focus more on ideas and strategies than the people behind them. In structured environments with established processes, individuals may be interchangeable. But in the startup environment filled with uncertainty, this approach can be fatal. Deep tech founders face unique pressures. They must solve problems that haven't been solved by anybody ever before, often in markets that don't yet exist. Without the right mindset, teams can falter under these conditions. As the venture mindset notes, innovation is a team sport. Without the right people, even the best ideas fail. Page 135 in the book. Slack's journey is living proof to this. Butterfield's team adapted, innovated, and ultimately created a product that transformed workplace communication. A more traditional approach might have abandoned the project after its initial failure. But instead, investors trusted the founder's ability to pivot and deliver results. When evaluating a startup or venture, the focus belongs on the team's vision, grit, and adaptability. Leaders like Butterfield demonstrate that a resilient team can take an idea, no matter how modest or unpolished, and create lasting impact. Overlooking the importance of the team is a common mistake. Stories of startups with promising ideas but poorly aligned leadership are cautionary tales. Execution drives outcomes, and execution starts with the people. Here is the insight. Ideas evolve, but great teams are built to adapt. As General George Doriot once said, a great A person with a great B idea will always outperform a great B person with a great A idea. Page 123 in the book. Let's wrap up this lesson with 3 questions to consider when evaluating a team or leadership. Is the team capable of navigating ambiguity? Reflect on whether they have demonstrated the ability to adapt and problem solve in uncertain conditions. How do the founders respond to setbacks? Think about their resilience, whether failure motivates them to innovate or causes them to retreat. Does the ecosystem attract and support exceptional talent? Consider whether the environment fosters growth for teams willing to tackle high-risk, high-reward opportunities. Betting on the right people transforms uncertainty into opportunity. Deep tech ventures demand leaders who can inspire teams and execute boldly. The question remains, who will rise to the challenge? Lesson number 4. Double down or quit. Know when to raise or fold. Picture a high-stakes poker game. You're holding a promising hand, but the cards on the table don't look good. Do you raise, fold, or wait for the next turn? Success in venture building is remarkably similar. Knowing when to double down or quit can mean the difference between a unicorn and a colossal failure. As the venture mindset puts it, smart investors plant the seed and nurture the startup with more and more cash. With every round, they can double down or quit. Read more about it on page 182 in the book. Deep tech ventures operate in environments where the stakes are sky high. Developing revolutionary technologies takes years of effort and burns through substantial resources. There is no guarantee of success, but there are opportunities to make informed decisions at key milestones. The ability to evaluate progress and act decisively, either increasing investment or cutting losses, is a hallmark of the venture mindset. Consider Airbnb's extraordinary journey. The company's first funding came from Sequoia Capital, which invested $600,000 in 2009, valuing Airbnb at just $2.5 million. Over the years, Airbnb passed critical milestones, expanding to thousands of cities, attracting millions of bookings, and eventually reaching a $100 billion valuation at its IPO. At every stage, Sequoia and other investors evaluated the company's progress and chose to double down. Their patience and strategic capital allocation paid off handsomely. Many organizations struggle with making disciplined decisions about resource allocation. Teams often get trapped in the escalation of commitment, continuing to fund projects that are clearly failing. Behavioral scientists have studied this phenomenon across industries from corporate strategies to military conflicts. The result is the same: wasted money, wasted time, and wasted opportunity. In traditional industries, decision makers tend to wait for all the information before acting. But by the time the picture is clear, the opportunity may be gone. Sequoia didn't wait to see if Airbnb's vision would succeed before committing further. Instead, the firm staged its investments, acting on new information at every round of funding. Each milestone brought risks, such as regulatory scrutiny or guest complaints, but the investors remained focused on the long-term potential. Staged investments are the cornerstone of the venture mindset. Breaking large decisions into smaller ones allows for greater flexibility, ensuring that resources are directed to the most promising opportunities. As the book notes, you can't play too safe and stay in the game. On page 184. This approach applies to everything from deep tech startups to industries like pharmaceuticals, where high-risk projects are funded in phases to maximize optionality. The alternative? Failing to adapt leads to stagnation. Too often, teams continue projects out of emotional attachment or sunk cost bias, draining resources that could be redirected to more viable opportunities. Successful investors don't just bet on ideas. They bet on the option to bet later. Sequoia's $600,000 seed investment in Airbnb was just the beginning of a $240 million total commitment. The firm's discipline and foresight enabled it to win one of the greatest VC bets of all time. Consider these 3 coaching questions to bring this lesson into your own decision making. What milestones determine whether a project deserves continued support? Define clear checkpoints for evaluating progress and outcomes. Second one, am I allocating resources based on potential upside or past investment? Challenge sunk cost bias by focusing on future returns rather than prior commitments. How can decisions be staged to retain flexibility? Explore ways to break big investments into smaller, manageable tranches to maximize optionality. Knowing when to double down or quit separates the visionary from the hesitant. The ability to act decisively while remaining flexible drives exponential outcomes. The question is, are you ready to play the long game? Here is lesson number 5. Get outside the 4 walls. Imagine finding a diamond in the rough, hidden in a place no one thought to look. In the venture world, these hidden gems often come from unexpected sources. Success favors those willing to step outside their comfort zones and search where others don't. As the venture mindset points out, deals like Dropbox happen in garages, coffee shops, and demo days, not in the confines of a corporate office. Read more about it on page 34 in the book. Breakthroughs rarely come from predictable places. In deep tech, where innovation thrives on diversity of thought and collaboration, the ability to source ideas from unconventional settings is critical. Networking across disciplines, geographies, and industries creates opportunities that wouldn't exist otherwise. Let's look again at the story of Coinbase, the largest cryptocurrency platform in the world. Its journey began with something most professionals overlook: a cold email. Gary Tan received an unsolicited message containing 0.05 Bitcoin, a currency barely anyone had heard of in 2012. Despite its suspicious appearance, Gary read on and decided to invest $300,000 in what became later Coinbase. That cold email turned into a return of over $500 million. This story illustrates a powerful truth. Opportunities don't always knock on the front door. Sometimes they arrive in your inbox. Many organizations and investors fall into the trap of limiting their idea sourcing to familiar networks. While it feels safe, this approach creates blind spots. Without diverse input, critical innovations may never surface. Relying solely on trusted connections can be costly. For instance, numerous investors missed out on Google because of internal biases and lack of openness to unexpected pitches. As the book highlights, every email could lead to the next Google. Dismissing cold outreach could mean passing on the next transformational company. The venture mindset emphasizes active and unconventional networking. From Sequoia's legendary hands-on search for WhatsApp founders in Mountain View to Gary Tan's willingness to entertain cold emails, the lesson is clear. Actively seek out new ideas and foster openness to unorthodox approaches. Failing to embrace this approach can leave valuable opportunities untapped. Many of the world's most transformative ideas have originated from unlikely places. Ignoring cold pitches, unorthodox collaborations, or diverse networks narrows the chance of finding the next big thing. Here is a nugget. Hidden opportunities exist everywhere, but only for those willing to search for them. As the venture mindset emphasizes, good VCs are good fishermen. Great VCs are also hunters. To integrate this lesson into practice, consider these 3 coaching questions. How diverse is the current idea flow? Reflect on whether inputs come from a wide range of industries, backgrounds, and networks. What systems are in place to review unsolicited opportunities? Evaluate whether there is an effective process to screen cold emails or pitches, ensuring no potential game is overlooked. Where can unconventional connections be fostered? Explore untapped avenues such as a niche conference, interdisciplinary collaborations, or emerging markets. Openness to unexpected opportunities separates great innovators from the rest. The question is, where will you search next? Lesson number 6. Make the pie bigger. Align incentives for collective growth. What motivates someone to work tirelessly, even in the face of uncertainty? It's not just money. It's the promise of shared success. When teams know their hard work leads to rewards they can truly own, everything changes. As the venture mindset notes, by designing smart contracts, VCs make founders' upside essentially unlimited while protecting them against downside risks. A rising tide lifts all boats. Page 211. One of Silicon Valley's secrets to success is simple yet profound. Align incentives so that everyone benefits. This mentality most visible in stock options, encourages collaboration, loyalty, and extraordinary effort. Consider Intel. When Intel pioneered the use of stock options for all employees, it shocked the business world. Previously, such rewards were reserved for executives, but Intel's founders believed ownership should extend to every team member. The result? Employees became emotionally and financially invested in the company's success. Apple quickly followed, and the results speak for themselves. Both companies thrived and created waves of innovation that transformed industries. Page 215 in the book. Another example, not in the book, NVIDIA. Known for its revolutionary GPUs, NVIDIA has minted thousands of millionaires through its employee stock option plans. Stories abound of engineers who started with modest means and retired with life-changing wealth. This alignment of incentives motivates teams to go above and beyond, knowing the hustle directly contributes to their future. But here is the challenge. In many organizations, incentives are misaligned. Owners and executives retain most of the rewards, while employees receive little beyond a paycheck. The impact? Disengagement and stagnation. As the venture mindset points out, in failing companies, owners are often greedy and they end up owning a lot of little or even everything of nothing. Page 211. Deep tech ventures with their long timelines and high risks demand exceptional commitment. Without meaningful rewards, it's unrealistic to expect employees to embrace the relentless grind. Why should they give their all if the benefits are reserved for a select few? Aligning incentives changes everything. Silicon Valley leaders like Intel and Apple understood this early. They created systems where employees shared in the upside, fostering loyalty and innovation. Stock options became more than just financial instruments, they became symbols of trust and empowerment. When teams know their contributions lead to shared success, their engagement soars. Contrast this with companies that don't share rewards. Greedy ownership demotivates teams, turning potential innovators into clock punchers. This difference in mentality often separates thriving organizations from those that stagnate or collapse. Here is an insight. A bigger pie feeds everyone. By aligning incentives, companies unlock unprecedented commitment, creativity, and results. NVIDIA's culture of shared success demonstrates how collective growth can drive exponential innovation. Reflect on these 3 coaching questions to assess how well incentives are aligned in your own ventures. The first one. Do all stakeholders, founders, employees, and investors have skin in the game? Evaluate whether the structure ensures shared rewards for collective effort. It doesn't mean everybody needs to invest money. Are the incentives significant enough to inspire extraordinary contributions? Small token rewards won't motivate teams in high-stakes environments. Does the system encourage loyalty and long-term thinking? Consider whether employees feel connected to the broader mission and vision. Aligned incentives create a foundation for innovation and growth. The question is, how big will the pie be and who will share in it? And the final lesson, great things take time. Think about planting a tree. For years, it looks like nothing is happening, just a sapling struggling against the wind. Then, one day, it bursts into bloom, bearing fruit for decades. Building something great, especially in deep tech, follows the same principle. It requires patience and a long-term vision. As the venture mindset puts it, venture capitalists bet on tectonic shifts that take time to mature and realize full impact. Going in early and with patience is the VC mindset's credo. Page 237. The allure of quick wins often tempts decision makers to prioritize short-term gains, over long-term value creation. But deep tech innovations don't follow this timeline. Transformative breakthroughs, those capable of disrupting entire industries, require years of research, development, and iteration. Consider SpaceX. Founded in 2002, it took nearly a decade for Elon Musk's rocket company to achieve commercial success. In its early years, SpaceX faced repeated failures, including 3 failed launches in a row. By 2008, the company was nearly bankrupt. Yet, Musk's persistence paid off when the 4th launch succeeded, securing a critical NASA contract. Today, SpaceX is not only profitable, but has redefined space exploration, becoming the first private company to launch astronauts into orbit. This journey was only possible because of a long-term mindset. Many ventures and their backers fall into the trap of expecting immediate results. This mindset can kill deep tech projects prematurely, robbing the world of potentially life-changing innovations. Short-termism doesn't align with the realities of creating disruptive technologies. The impatience for quick returns often leads to poor decisions, such as cutting funding for promising but slow developing projects. Teams lose morale, investors lose confidence, and groundbreaking ideas, they never reach their potential. The venture mindset champions patience and staged investments. Like SpaceX, successful ventures evolve through disciplined, long-term support. Early failures are not the end. They are part of the journey. As the book notes, you can't rush tectonic shifts. They take time to reveal their full impact. On page 237. This principle is echoed across other industries, like pharmaceuticals, where drug development spans decades but can result in life-saving breakthroughs. Abandoning long-term opportunities for immediate wins might yield short-term gains, but it sacrifices the exponential impact that comes from staying the course. Without this long-term vision, the next SpaceX, Moderna, or Nvidia might never see the light of day. Here is an insight. Long-term success demands long-term thinking. Deep tech founders and investors must embrace the patience required to create value over time. As SpaceX's journey illustrates, great things take time, but they are always worth it. Reflect on these 3 final questions to align your strategy with a long-term mindset. Are investments and decisions focused on short-term profitability or long-term value creation? Challenge yourself to prioritize enduring impact over immediate returns. What milestones signal real progress even if success feels distant? Establish clear, measurable goals to maintain confidence during the slow growth phases. And the 3rd question, am I prepared to persist through failures to achieve ultimate success? Evaluate your tolerance for setbacks, knowing they are part of the path to breakthroughs. Patience isn't just a virtue, it's a strategy. The question is, how far are you willing to go to create something truly extraordinary? So let's prop today's episode up. The venture mindset isn't just an ordinary tour guide. It's a playbook for thriving in uncertainty. Let's distill its essence into actionable insights. Here are my major lessons from the book. The first one, home runs matter, strikeouts don't. Failure is inevitable, but a single big win can make all the difference. The second lesson, prepare your mind for contrarian thinking. Be ready to spot opportunities others miss. The third one, bet on the jockey, not the horse. A great team can adapt and thrive even if the initial idea doesn't work. The fourth one, double down, or quit. Strategic capital allocation ensures you scale the right opportunities. Number 5, get outside the four walls. Innovation often comes from unexpected places. Diverse networks and cold outreach matter. The sixth one, make the pie bigger. Align incentives to encourage collaboration and loyalty. And the final lesson, great things take time. Patience is key to realizing the full potential of deep tech ventures. Each of these lessons offers a blueprint for navigating risk, evaluating opportunities, and building lasting value in ventures, whether as a founder, investor, or corporate leader. Here is what resonated the most with me. This book reinforced the importance of focusing on what truly matters in building companies and investing in them. The emphasis on disciplined decision making, resilience, and long term thinking felt like a masterclass for anyone striving to make an impact. The real world examples were inspiring and relatable. If there's one area where I wished for more, it would be deeper dives into cross industry applications. While the lessons are universal, I would have loved more examples outside tech and venture capital, for example, from the corporate world. If you are ready to dive deeper into these transformative ideas, pick up a copy of The Venture Mindset today. You can find the link to Amazon in the description of this episode. To recap, we have explored 7 lessons that can reshape how you approach uncertainty, risk, and growth. But remember, this episode only scratches the surface. The book is packed with even more insights to help you build and scale with confidence. Stay tuned for the next episode where we will dive even deeper into the venture mindset with an interview of Alex Dang. Until then, keep learning, keep growing, and stay bold.